Welcome back to Stock Spotlight. I'm your host, Michael. Today's episode is about exiting positions. In my view, selling is harder than buying and far more important for long-term returns. Most investors focus all their energy on screening new companies, building watch lists, and waiting for the right entry point. But the sell decision has as much impact on your portfolio as the buy decision. Selling determines which ideas survive, which ones compound for you, and which ones you remove before they damage long-term portfolio performance. My goal today is simple. I want to give you a clean, repeatable framework for knowing when to sell a stock. This is the actual approach I use inside my own portfolio. I am going to walk you through my core selling principles, the risk boundaries, and 2 case studies from companies that I've covered here before, bought and sold from my portfolio. Duolingo from episode 11 and e.l.f. Beauty from episode 5. We'll close out with a list of 5 questions to ask before selling. Let's get into it. Before going further, it is important to clarify who this framework is for. It's designed for long-term investors who still want explicit risk boundaries around their capital. The objective is not to trade in and out of positions, but rather to remain invested in high-quality businesses while avoiding the small number of deep losses that cause the most damage to long-term compounding. The math behind losses is unforgiving. A 30% decline requires a 43% gain just to break even. A 40% decline requires 67%, while a 50% decline requires a 100% gain. Losses compound against you. As drawdowns deepen, recoveries become both harder and slower. Capital tied up digging out of a hole is capital that cannot be redeployed into better opportunities. That is why selling is not about market timing, but rather it's about capital protection. There is also a behavioral dimension. Investors tend to hold losing positions too long and sell winning positions too early, a pattern known as the disposition effect. Realizing a loss forces you to confront a risk management principle or a flawed thesis, while selling a winner feels emotionally rewarding. A structured selling framework exists to counter those instincts, impose discipline, and introduce objectivity into decision-making. The first job of selling is risk management, especially in the first 0 to 90 days of owning a stock. This is the period when uncertainty is highest and conviction is still forming. Early positions carry elevated model risk, narrative risk, and behavioral risk. During this phase, I use predefined downside boundaries using price as the main risk signal to protect capital. I originally relied on a simple fixed percentage stop guideline, typically exiting if a stock fell between 15 to 20% from my entry price. That approach still works reasonably well. For those unfamiliar, a stop loss is a predefined price level where you accept that risk has changed enough to step aside. It prioritizes capital protection over precision. A trailing stop serves a different purpose. Rather than being anchored to the entry price, it moves higher as the stock price rises. Trailing stops are commonly set to sell if the stock falls to, let's say, a 75 to 80% range of its most recent high, helping protect gains while still allowing upside to compound. Now, more recently, I have shifted toward a volatility-based approach with new investments, experimenting with a 2x or 3x average true range framework because this ATR framework scales risk to each stock's volatility. This concept actually goes way back decades to even the turtle traders who use volatility-based stops, which I think was roughly a 2x ATR style rule, specifically so they wouldn't get shaken out by normal price noise. ATR essentially defines what normal movement looks like for a stock, so higher volatility names get more room, while lower volatility names are naturally tighter, without relying on arbitrary percentages. The key here actually might be position sizing. A wider ATR stop means more dollar risk per share, so you simply take fewer shares to keep your overall risk the same. ATR bands are also easy to visualize in platforms like TradingView. Now, I do want to say that a buy and hold approach can absolutely work over long periods, particularly when turnover is low and investors are willing to tolerate volatility. The trade-off is that you implicitly accept deeper drawdowns and longer recovery times. Many investors underestimate how difficult those periods are to actually endure in practice. Risk rules do not exist to avoid losses entirely. They exist to keep losses small, recoverable, and non-destructive to long-term compounding. Everything else in this episode builds on that idea. Drift in your investment thesis should be one of the primary reasons driving long-term sell decisions on stocks. At that point, price matters far less than whether the underlying business is still delivering on your original thesis. To help in this process, I write out 3 things before I buy a new stock. The first is a clear, concise investment thesis statement, usually between 2 to 4 sentences. I then like to add on at least 2 KPIs that I will track, and you might choose 1 or even more than 2. And then third, I like to write down at least 1 key risk that could undermine the investment thesis. This information then gets entered into a dedicated worksheet within my larger investing portfolio workbook. The thesis defines what has to be true for the investment to work for me. The KPIs define how I measure whether the thesis is playing out in real time. And the 1 key risk forces me to be honest about the thing that could break the story. The key point is this: if new information contradicts the thesis, or if the KPIs start moving the wrong direction, that becomes an immediate signal to reassess. It brings structure to the decision instead of emotion. One improvement I've made recently is adding predefined exit rules for a new company that I want to buy shares in. After I finish a podcast episode and before I buy any shares, I ask myself one direct question. Right now, what specifically would make me sell this stock? I do this while the research is fresh and before I'm emotionally attached to the position. Writing that answer down matters since it gives me explicit permission to sell later if those conditions show up. For example, if my thesis depends on paid user conversion expanding and the key risk is that conversion never scales, then a predefined exit rule might be that paid conversion stalls for several quarters in a row. That does not mean that I automatically sell on the spot, but it does trigger a structured reassessment of the thesis. This turns selling from a reaction into a decision I already agreed to in advance. Predefined exit rules do not mean you will always sell perfectly. They do mean that you will sell intentionally, and over time, that discipline matters far more than trying to be precise. Once I sell a position, it falls into one of the following categories. First, a shift in investment thesis. This is if the original assumption no longer holds. Key KPIs deteriorate, competitive dynamics change, or management execution diverges from expectations. The second bucket is higher quality expected return elsewhere. While the business may still be solid, capital can be redeployed into a superior opportunity. This is a quality-driven opportunity cost decision. The third bucket is portfolio rebalancing. Position size, valuation, or correlation drifted beyond comfort, even though the thesis remains intact. The fourth bucket, risk management. A predefined risk boundary is violated, such as a stop loss, trailing stop, or ATR target. This is a rules-based exit focused on capital protection, not fundamental judgment. And then the fifth bucket, acquired by another company. The investment thesis resolves through a takeout, often crystallizing value sooner than I expected. I believe that categorizing sells reinforces that not all exits mean the same thing. Some are defensive, some are opportunistic, and some are mechanical. But every sell should be intentional, documented, and aimed to mostly come from the shift in investment thesis or higher quality return categories. Once the early ownership phase passes and the thesis has been validated, the most important discipline is often restraint. The best thing we can do as investors is allow our winners to run. As a position matures, selling shifts away from risk control and toward capital allocation and portfolio quality. This becomes especially relevant when you are continuously researching new companies, maintaining active watch list, and generating stronger investment alternatives over time. One question I find particularly useful is what I call the fresh start test. If I were building the portfolio from scratch today, would this stock still earn a spot? If the answer is no, that is a signal to reassess, not an automatic sell. It forces a direct comparison between what you own and what you could own instead. Many positions that fail this test have been strong long-term winners, purchased under conditions that made sense at the time, but may no longer represent the best opportunity today. That is where opportunity cost comes into focus. Every position held is capital that cannot be allocated elsewhere. In tax advantage accounts, the friction to upgrade is low. However, in taxable accounts, the hurdle is higher, and the replacement opportunity must be clearly superior to justify the tax cost. For that reason, selling purely to rebalance weights is secondary for my process. The more important question is whether capital can be deployed into a higher quality business at a more attractive valuation with stronger durability or better long-term tailwinds. Upgrading portfolio quality over time is a core part of long-term investing. It is about continuously reallocating capital towards your best ideas and keeping the portfolio aligned with where expected returns are highest today. Let me walk through how this framework applied to Duolingo, which I covered back in episode 11. When I first analyzed the business, the operating metrics were strong. My thesis centered on 3 core drivers: growth in daily active users, improving conversion of free users into paid subscribers, and double-digit free cash flow per share growth. At the same time, even in that episode, I acknowledged 2 open questions. Valuation expectations were elevated, and the long-term defensibility of the moat, particularly in the context of this new world of Gen AI, was still uncertain. That combination did not make Duolingo investable to me, but it did warrant caution. As a result, I initiated a small starter position shortly before the episode was released in December 2024 and early January 2025, buying shares in the $313 to $327 range. What ultimately led me to sell the position a few months later, in May of 2025, was not really a deterioration in reported financials. Instead, it was a qualitative thesis drift tied directly to a risk that, in hindsight, I should have made more explicit up front. In April 2025, about a month before I exited, leadership commentary suggested that AI could meaningfully replace teachers and human-led content creation. That marked a shift in the product narrative that I was no longer comfortable underwriting over the long term. To be clear, I agree that Duolingo should be leveraging AI aggressively. However, part of what historically differentiated the product was the human element in lesson design and progression. Online user sentiment at the time suggested that this human touch was central to the app's appeal, and removing it risked changing the product in ways that were difficult to model. Around the same period, I also began to notice softer signals around user engagement being discussed on X, and while these were not definitive in their own right, they represented potential leading indicators worth paying attention to. Taken together with the leadership commentary, they reinforced a growing disconnect, and that disconnect mattered. A core assumption in my thesis was confidence in the long-term direction and durability of the product. When leadership communication begins to conflict with how you originally underwrote the business, that is a meaningful qualitative signal, even if financial statements still look healthy. At that point, exiting became the rational decision. In this case, I had not created predefined exit rules tied to that risk ahead of time. I ultimately exited the position around $527 and reallocated that capital into FICO later last summer. The timing worked out favorably, but also included an element of luck. The more important takeaway for me was the process lesson. Today, I am far more deliberate about explicitly defining key risk up front, particularly qualitative risk tied to leadership decisions and long-term strategic direction. I now elevate those qualitative risks to the same level as financial assumptions before initiating a position and define in advance what would constitute a sell if those risks begin to materialize. For our next selling case study, I want to revisit e.l.f. Beauty, which I covered back in episode 5. My original thesis centered on strong product velocity, digital-first share gains, and continued retail expansion. The brand was clearly resonating with consumers, sales growth was strong, and execution across both cosmetics and skincare was outperforming their broader industry. At the time of the episode in October 2024, I viewed e.l.f. as a high-growth disruptor in beauty with a reasonable starting valuation. The key risks to that thesis included potential disruption from a TikTok ban at the time, given the brand's reliance on digital and social-driven discovery, and also the inherently sales and marketing intensive nature of the business, and elevated competitive intensity within mass beauty, along with their supply chain exposure to third-party sourcing and manufacturing, primarily in China. I ultimately felt the valuation was compelling enough, all things considered, to begin building a small position shortly after the episode aired, adding shares between October 2024 and January 2025 with an average cost basis of around $99. Fundamentally, the business continued to execute reasonably well early on, but the stock began to move lower in early 2025. What ultimately triggered my exit was not a sudden breakdown in fundamentals, but a violation of my downside tolerance, as e.l.f. breached roughly a 30% drawdown from my entry range, which led me to exit the position in late February 2025 at $69. This case reinforced why explicit downside boundaries matter most early in ownership. When uncertainty is highest and conviction is still forming, price-based risk rules exist to protect capital during the learning phase. In hindsight, allowing a 30% drawdown was too wide. My process today favors tighter early-stage risk limits with using a 2 or 3x ATR threshold to avoid letting those new positions get too far against me. It also reinforced a broader industry lesson. Beauty is an attractive category with high gross margins, but it is intensely competitive and requires constant innovation, marketing investment, and brand reinvention to sustain relevance. Compared to more infrastructure like Tool Booth or B2B business models, downsides can materialize quickly once that momentum slows. In e.l.f.'s case, revenue growth decelerated all the way down to 3.6% in Q4 25, which was the quarter right after I sold, breaking up a streak of 5 consecutive quarters previously above 30% year-over-year growth. While that data point came later, the experience reinforced the importance of early risk control and why early and mature positions require different selling tools. To round things out, here are 5 questions that I now ask myself before making a sell decision that might be helpful to you. First, is my original investment thesis still intact? Second, are the KPIs and risk trending in the right direction? Third, if I were building the portfolio from scratch today, would I still own this stock at this weight? Fourth, does reallocating the capital meaningfully improve overall portfolio quality? Fifth, has a predefined risk boundary been violated, for example, a 2 or 3x ATR? Not every sell requires a yes to all 5, but the goal is to create structure and remove emotion. In closing, selling is not a failure. Selling is an investment decision like any other. The goal is not to hold every stock forever. The goal is to compound, and compounding works best when your portfolio reflects your highest conviction ideas, supported by data, protected by risk boundaries, and refreshed through periodic upgrades. That wraps up today's episode of Stock Spotlight. I hope this episode gives you a clear exiting framework that you can use in your own process this year. If you enjoyed today's episode, drop a comment or take the episode poll. And for real-time updates, follow me on X at Invest091. Join me in February when we'll dive into Viva Systems, ticker symbol VEE Vive. Until then, keep your investment smart.